Hey traders, welcome to Charts and Coffee. Hope everyone is having a great morning. And we are going to take a look at what we're dealing with here today, as there's been a pretty rapid climb over the past couple of days. You can see here the Friday surge, the don't fade Friday rule was in effect, gap up on Monday as we transition from the March contract to the June contract. And then today we've got a little bit of, so far, an inside candle. Now, a couple of things to keep in mind for the rest of this week. And I'm going to take us on over to the economic calendar for this. All right, let's see. There we go. Today we had already, although it really wasn't much of a market mover from what I can tell, we had the building permits and the housing starts pretty flat, as you can see here. Nothing really, slight revision lower on the building permits, slight revision lower on the housing starts, and both of them came in line. So not much to react to. Ultimately, tomorrow is FOMC day. We are not expecting, if you take a look at the data, there is no reason to expect anything in terms of change in the rates. It's 99% priced in that it's going to be a hold. It's also about 79% priced in that it will be a hold for the May 7 meeting as well. The FOMC, the hardworking bunch that they are, take April off. And you'll see that May is still pretty much a hold. You go into June, and this is where the conversation gets to be a little bit more interesting. So on Wednesday, we'll be looking to see if there's any clarity. Does May just kind of dig its heels in and we see a hold in May, and then we get into June? And this is where, at the press conference and with the rate statement, traders are looking for a clear look. They're never going to say we're going to cut in June, right? They're never going to be that clear. They're never going to paint themselves into that much of a corner. But they do know what Fed Fund futures are saying. And Fed Fund futures are saying, Jerome, we expect you and your merry band of FOMC voting members to cut at least 2, if not 3 more times. And that's what's priced in right now. If Jerome doesn't agree with that, he will start to change those expectations with his words. All right, so then that's the first big thing for the week as we get into FOMC. And then the next thing is going to be OpEx on Friday. This is known as triple witching. It's not really quad. There's no fourth market, but it is triple witching. But whatever it is, here's what we know, right? Regardless of what's expiring, the end of the quarter, so the March 3rd Friday of the month, the June 3rd Friday of the month, the September 3rd Friday of the month, and the December 3rd Friday of the month aren't just your garden variety options expiration or OpEx. It's much, much bigger because you've got the roll of the futures contracts, you've got the expiration of the biggest group, typically in terms of open interest, of options. And another thing to keep in mind, and so you got futures options, futures, and stock options, hence the triple witching. You got those 3 things happening on this Friday. But even bigger than FOMC, frankly, and option, if I were to rank the big 3 things that are coming up this month, number 3 would be OpEx. Number 2 would be the FOMC. And I would actually say number 1 is actually going to be the last trading day of this month, which is Monday, March 31st. Because this is when, if we're going to see this, I'm not saying we're putting in a bottom, but if there's timing around any kind of bottoming action where a longer term mindset from a large sum of money, so think your hedge funds, think your portfolio managers, think of folks that have a massive amount of capital under management. If they decide that this is the time to dig their heels in with the anticipation that Q2, Q3, Q4, as the Federal Reserve is going to cut likely 2 to 3 more times, might be the time to dig in. End of this quarter could be very interesting, and I'll be keeping a really close eye on that. So speaking of that, how do we keep a close eye on that? Take a peek here. It's the weekly time frame. And a lot of what I'll be talking about between now and really the end of month is how do we position ourselves to take advantage of the end of this quarter and movement that we're seeing on the weekly chart. The weekly chart and the daily chart, this isn't about looking at the two of them agreeing. The daily chart for me is looking at longer term swing trades. Can I put on a trade that could last days to weeks? My typical time is sort of an average of 2 to 10 days, but it can go days to weeks. On the weekly, it's a different job. So if you're of the mindset of multiple time frame confirmation, it might be, well, the weekly and the daily have to be in agreement. I take a different look at this. I look at the daily time frame being a slice of psychology that lends itself well to an outlook of days to weeks. I look at the weekly time frame, however, in a very different way. I look at the weekly time frame as a way to look at setups that could be months to years. Remember, we only get 4 weekly candles per month, right? So the formations, the patterns, the pullbacks, whatever it is, generally are going to take a little bit longer to form. And if that weekly time frame is something that you're looking at right now, and you're looking at some of these 5, 10, 20% pullbacks, you're looking at some of these longer term mean reversions, you're looking at pricing on the weekly that we haven't seen in a really long time. And if your outlook is months to years, here's a really simple question. And again, it's not that anyone knows the answer, but it's that we play a probabilistic game. We're not trying to tell the future. But here's what I'm going to ask everybody. For those of you, especially who've been trading for 10 years or longer, maybe 20 years or longer, how many times do you see pullbacks like this, where in 12 to 18 months, you're going to say, gosh, that was the blue light special. That was the sale. That was where there was a really great opportunity to build some longer term, months to years type positions. So that's all I'm going to put out there. When you're looking at that weekly, ask yourself, will I be kicking myself a year, year and a half from now for not taking advantage of the pullbacks? Now, notice I'm not saying picking a bottom. I think the place where a lot of traders do get into trouble is if they look at that weekly time frame and they identify a downtrend, for example, or they identify a stock that has yet to get above, for example, it's 200 period exponential, or even simple, and they start to pick bottoms in very, very weak markets, as opposed to taking advantage of pullbacks and generally strong ones. So the watch list selection matters a lot. Comparing, say, Amazon to Boeing is two very, very different stocks. One is pulling back in a way that there's a probability of follow through to the upside, while the other is still sort of languishing in a lot of volatility. We step out to things like financials, right? Versus, say, well, I'll show you semiconductors as well. Semiconductors are a little bit more choppy. Financials are really quite strong. And while there might be an opportunity in both, one is clearly still in an uptrend on that weekly time frame. So if we can prioritize those things and have more of a mindset of, this doesn't have to be an instant gratification. Hey, in a month or two, I'm seeing a massive return. This is really more about, hey, in a month or two, am I up on the position? In 6 months, am I up maybe 5% on the position? And could I be open to holding this thing for months to years? So case in point, let's just give a little bit of an example. When you watch those morning shows, I don't watch any of them, but I remember when I was homesick as a kid, they'd be baking a pie on the whatever, Today Show. And we didn't wait around 45 minutes for the pie to bake, right? They'd show how they put it together. They'd reach under the counter and they'd show you the finished pie. Well, that's kind of what I'm doing here. Reaching under the counter and I'm showing you the finished pie. Let me show you all Coke. This is a very recent position that we built in the Sector Secrets Mastery with this longer term thinking. We bought this at $61.50. All right. So, and this was about 2 months ago. Do I look at this and say, yeah, I'm pretty content with where I am 2 months later? And am I looking at Coke as a symbol that I could continue to hold from $61.50 for the next few months to years? So far, the answer would be yes. We did the same thing in Altria. Bought this thing for about $51.50. Again, just kind of thinking forward, when that thing pulled back, my thought is this a level from which at least 6 months from now, I might be able to see a little bit of a return to justify holding this thing possibly for years? Yeah, Altria is punching up to brand new highs after a $51.50 pullback. entry. That's what I'm talking about. Now, staples pull back a little bit differently than some of now these are staples. These are more defensives. These pull back a little bit differently than, say, the setups we're seeing in technology or consumer discretionary financials, but it's the same idea. Again, the mindset here is in 12 to 18 months, am I going to regret not looking at right now as an opportunity? Because golly, how do you know, Rog, there might be an opportunity? I'll tell you how easy it is. Turn on the television, and if you can stand to watch it, whatever financial media you're watching, if you can stand to watch it and listen for more than 30 minutes, the more bearish they are, the more the guests are talking about terrible outlooks. There is some social sentiment capitulation when everyone's bearish, and we can go find a stock in a longer term time frame or an ETF in a longer term time frame that's bullish. That's a sale, not a stock that's getting hammered, not a stock in a downtrend on the weekly, but something where the sentiment is creating that correction. And for the most part, you'll notice this: when the market is up, the guests and the analysis is bullish. And when the market is down, the guests and the analysis is bearish. So take a little bit of a contrarian view to that. Use it as an opportunity. Use that 12 to 18 month sort of litmus test in your mind, that mindset, and say, yeah, Rog, I'm probably going to regret not at least putting together a shopping list, right? So we'll be talking about that a lot more in the mastery. Those are two of the most recent trades we put on, just to show you this is the mindset. And we did something similar in 2022 when there was a lot of fear, when we scooped up things like XLK, right, from $1.21. I think it's still over $200 right now. So don't forget, I know it's so easy as traders to live and die by a today trade, live and die by, I want to get in today and out today. A lot of times we're leaving a lot of, well, frankly, profit and opportunity. We're leaving a lot of it on the table, but not embracing a slightly more longer position trade type mindset. So while you're doing all that swing trading on, say, the daily time frame, which I love to do, make sure you're giving that weekly at least a nod. All right. Okay. That being said, let's take a look at whatever questions are out there. And if you need a little bit of guidance on this, okay, Rog, I get the gist of it. Kind of running through my mind. Yeah, I know a year and a half from today, I know I'm going to regret not taking advantage of some of the pullbacks here. So how do I start? This is where I would tell you, start at the top of the food chain, maybe the SPY. And don't take my word for it, although I think you'll see pretty quickly there's a process. But go back and look at pull up the SPY for 20 years if you'd like, and look at the last handful, or all of the ones that happened where you get a 5, 10, or 20% pullback in the SPY. And then look 12 to 18 months later. Do the same thing with the QQQ. Do the same thing with any heavily weighted sector or stock. And you'll see, okay, Rog, I'm starting to see what you're talking about. All right. Question here is AMD for long puts. Here's where I'd say in terms of timing, Jas, what I would say in terms of timing, we have tomorrow Powell, and I sent out an alert to my Sector Secrets Mastery folks and said, look, if Powell sounds the least bit accommodative, we're going to see the markets roar because rate cuts are bullish. I hate look, I'll tell you this. I hate downtrends. Uptrends are the easiest market to trade for the vast majority of traders. And these very brief periods of time, and they typically are brief, gang, the very brief periods of time that we're in a more significant correction. And what would be a significant correction? Significant corrections are typically corrections that are greater than 5%, right? 10%. Even once you get to 20, you're going to see a markets in turmoil special. By the way, did you know that every single markets in turmoil special, I'm kind of rooting for one, 12 months later, 100% of the time, equities are higher. That's what I mean by a little bit of contrarian thinking. So do I like long puts? Look, that's the only thing I can do on the on AMD. So yes, long puts, if price reaches the volatility resistance, yeah, that would be definitely something to keep an eye on. Just keep an eye on the week in terms of events and these scheduled events that we know are coming. Forget the tariff stuff. forget the geopolitical stuff. We can never time that. We don't know when it's going to happen any more than we can time upgrades and downgrades from brokerages. Some things are just going to come, when they come. They're not going to have any kind of projected, anticipation. Hence the sudden reaction to them. But things like tomorrow's FOMC, things like OPEX on Friday, things like end of month, we know these things are coming. So I would just be careful if I'm buying a put into Powell tomorrow. Now, the flip side of that is if Powell does not sound accommodative, if he looks at those Fed fund futures with the merry band of FOMC voters and say, no, they're way too dovish. The expectations are way too dovish. It's not in alignment with what we think we're going to do. In other words, how many or when the rate cuts will start, that could send equities lower. We really just don't know. But if we're going to play probabilities, yes, find a downtrend, find a great weak downtrend, right? AMD is a really good example. And then take advantage of the move into resistance if we get follow through off such a move. And it's 1 p.m., 1:30 p.m. tomorrow, and you can take a little bit of profit off the table. That I would totally do that. Yeah, I would totally be fine with that kind of timing. All right. Ren asked, when looking at the Darvis, if the candle closes midway to the top line, would I go long calls? No, Ren, if I'm looking at the Darvis, and it'd be good. I mean, I don't know if you have an example. I'm trying to think of some symbols we've been looking at, staples. Actually, staples are a pretty good example, right? This is how you'd set this up. There's your Darvis. Here's your mid right here, about 155. No, what I would say is you want to be in the lower quarter. You want to be in that lower quarter or as close to that yellow support line of the Darvis as possible, right? Or as close to. I need to get rid of these lines right here. These are actually the sanity check lines that show a 5. So by the way, this white line is 5%, 10%, 20% from all-time highs. I don't want to confuse this with the Darvis. Here we go. So the closer to the Darvis support, the better. Lower quarter of this zone is where I'd buy the calls, right? And by the way, this has a lot to do with taking heat, right? Actually, this is a really important topic and probably a good one to kind of wrap the show up on. So one of the things that hurts traders when they're looking for consistent account growth, it doesn't matter if it's longer term position trades that we've talked about or swing trades or frankly day trades. There's language around risk management. There's a language to account growth. And one of the ones that traders often overlook, and this is something that TradesViz does allow you to measure, is max adverse excursion. What the heck is it? MAE. Okay. How many times have you all heard me talk about if the journey to the target is untenable, it's not a trade? A lot of times, especially options traders are really guilty of this, and stock traders too. When we look at an initial target, there is only so much unrealized loss that makes sense, because at some point, especially with an options trade, that unrealized loss, the amount of unrealized loss we had on the trade, could become realized. In other words, what was just a negative P&L on the unrealized part of our platform, where we know it could vacillate, becomes real because we got to close the trade out. And if we don't realize that maximum unrealized loss is something that we have to consciously be aware of, what happens is traders start risking, say, here's a really common scenario, max debit. Well, what is that max unrealized loss? 100%. They're willing to risk 100% in an effort to do what? Make 100%? No, usually make 10, 20, 30, whatever they can eke out as a profit. Does anyone think that's a repeatable process, right? And that's where that's a really simple metric that I will tell you not 2 in 10 traders look at. So let's go back to this PM trade. If I buy in the midway of the zone, what's my maximum unrealized loss that I can tolerate? So the higher in the zone that I buy, if we pull back down to the lower part of the zone, that might be an untenable journey, right? We cannot hang on to the trade on the way to, say, call it a 160 target or a 159.50 target. So how we get to the target matters. I know most traders don't think about this, but most traders also have a chutes and ladders type approach to trading. They might get a small win here, small win there, and then max debit. And worse, max debit on a trade that they added to the losses of. So not only then are the losses greater in size than the wins, they could also be greater in number. And that's where you run into a big problem. So I'll give you a good example of the mastery this month. We've had 11 trades, swings, that have closed out so far this month. 4 of them were losers. 7 of them were winners. So right away, the win rate, I don't really care. What I really, not as much, not more than this. My winners were greater in size, not just in number of winners, but in terms of return than my average loss. And that's a metric that we all need to understand. And PM is a great example of the closer we can be to the support, the less the potential max unrealized loss. All right, gang, that's a wrap. As always, thanks so much for being here for Charts and Coffee. I'll see you on, actually, just a quick heads up. I won't see you all till next Monday. All right. So Charts and Coffee will be back on Monday. Be good to each other.